Look, if this is a rotation, shouldn't the small caps be doing better?
Kelly, first of all, it's great to see you. But the problem is here, there's two issues at work. Number one, I don't think the rotation, I'm talking the rotation more about value to, growth to value as opposed to big cap to small cap. I think there are some really structural impediments in the way of the small caps. And while lower rates are potentially very helpful to them, these are the most economically sensitive companies, and many of the companies in the Russell 2000 don't make money. So it doesn't mean that it's going to make it any easier for them to raise money or become profitable. And so that's why I'm a little bit, I remain very cautious on the Russell 2000. I think that was a bit of a breakout through 2100. It's looking like maybe it's a false breakout. As we retest that, we'll have to see.
So if
but I think the value stocks are doing better.
Sure. And sorry, I didn't mean to clip you there. If it's a false breakout,
no, not at all.
What does that tell you? Where would you be in the market, especially now with what rates are doing?
Well, right now, I think you can't go too wrong with value stocks, with dividend stocks, with the rates coming down, right? If you're getting a nice solid dividend from a company, very importantly, from a company that has the cash flows to support its dividends, if you're going to be invested in the market, that's a safer place to be. Because right now, you want something that's a bit recession-proof, because the bond market, with the moves that we're seeing, they're screaming at us right now to tell us that they think we're looking at a recession. You don't see, two-year yields go down 65 basis points without some sort of economic message to take away from it. And that's really what we're seeing these last few days. And so another problem is, when you can't price risk-free assets, and two-year treasuries are among the risk-free assets, it's very hard to price risky assets like stocks. So this sort of bodes for a bit more of a defensive posture until we can really see if this is a temporary storm or bumpy landing, so to speak, or if it is indeed a harder landing.
It feels like a return to the risk-on, risk-off kind of framework, where the last couple of years, let's not forget, every time we had bond yields going up during the inflationary period, that would be a headwind for stocks. Now we're back to the olden ways where bonds and stocks would kind of rise and fall together. And I mean bond yields, that is.
Yes. Well, part of it, Kelly, is we can't discount the effect of the carry trade. And I think that's had a big impact on risk off right now. It was very profitable for all sorts of leveraged investors to borrow yen because it's essentially, yielding nothing. So it's really a very cheap currency to borrow in. The problem is the yen's moved from about 162 to 146. And you saw the way that the Nikkei plunged, and that's a lot of investors who borrowed yen to buy Nikkei. I think a lot of investors had also borrowed yen to buy momentum stocks, such as the Mag 7 or the NASDAQ 100 or NDX. There's been a tremendous correlation between the yen over the last few days and the last few weeks, and the NASDAQ 100. The only exception being that real head fake rally that we had on Wednesday. We're right back to that relationship now. So I think that's where the risk off comes from. I think it's very much related to the carry trade and a lot of either risk managers saying we've got to lighten up, or margin calls actually coming in. So neither one is a pleasant situation.
But I like what you're saying, because we often see these at the end of a market era. And if this is the end of the inflationary era and it's blowing up, positioning that worked during that period of time but no longer does, well, that's unfortunate for people in those positions, but it could be fine for the rest of us. If the Fed gets its act together and cuts here enough that the market kind of feels calmer about the business cycle and the data holds in okay, I don't see why this wouldn't be an opportunity for things, I don't know, valuation-wise, like the Russells, but, sort of philosophically speaking, they didn't make any money for the last 3 years because of high interest rates. If those rates really are coming down now, it would seem logical to me that there's a fundamental reason they could start to do better.
For the small caps, some of it's because of high interest rates, some of it's because of availability of capital, some of it is because of just the fact that these don't have the pricing power or the market power that a lot of your larger cap companies do. One of the reasons people love to invest in the big cap tech stocks is because they've got tremendous pricing power and tremendous market power. It's exactly the flip side for the smaller cap stocks. But regarding the sea change in sentiment, that's why I think we're seeing a lot of the movement out of the momentum type of names and out of growth into value. I've been trying to use the term rotation because the problem is these big cap tech stocks are such a heavy weight in the indexes. It's masking the fact that there's actually been a movement into value stocks, and value stocks have severely outperformed in the last couple of weeks here.
And that's where you would stay?
For now, yes. Until we resolve where we're going, I think it's prudent to sort of wait and see. They're a good place to wait and see because of the dividends and because of they have their own sort of earnings power as well, at least in sort of staples and other defensive names of that nature.